Treasury yields rose again today after the Labour Department released stronger than expected weekly jobless data. Joining us now, Jeff Sherman, Deputy Chief Investment Officer at DoubleLine Capital. Jeff, good to see you as always. Thanks for joining us.
Yeah, thanks for having me, Wilfred.
What's going to move yields more, the jobs print or CPI next week?
Well, both of them are very important numbers. As you said, with the jobless claims, and everybody focused on the initial claims and these, the downward trend there. But what we've been following for the last 18 months is the continuing claims. And these are people that continue, by definition, to receive unemployment benefits. And given that the extraordinary measures from the COVID and CARES Act that took place last year expired around Labor Day, we're finally seeing that data trickle through. And there's been a significant drop-off in the number of claimants there. In fact, last week, you saw roughly 6.5 million people drop out of receiving some form of benefits, and an additional million or 1.3 million today come out. So we're talking about roughly 4 million people receiving benefits in the most recent print, versus where we were at 12 million plus. So I think we're at a really big juncture here to see if the consumer can stay on their own and what that means for the labor market. But as you mentioned as well, CPI is definitely on investors' minds. And, the Fed, talking about their target for inflation that's going to dissipate next year, it's like 2.2%, is very puzzling to us, and trying to figure out how they think it's just going to dissipate and these transitory effects are going to disappear overnight. So I think both of these things are very important, and I think it really sets the stage for a catalyst for rates to move, and that's to the upward side.
Why have rates been moving higher and backing up like we've seen, Jeff, in the face of GDP downgrades, slower growth?
Well, if you think, you think about it, it's a mixed bag here too, Sarah. So what you've seen too is you've seen improvement from the Delta variant, right? You've seen really an uptick in vaccination rates globally. And further to that, we've seen a lot of improvement in just economic sentiment as well, right? Look at the jobs numbers, look at the ADP report this week. And again, I think the bond market is really digesting inflation. So a lot of those headwinds you were seeing really towards the end of the second quarter and really throughout most of the third quarter are really, some of those are dissipating. Yes, GDP is being downgraded. Then again, you're still talking about a growth rate that's running an annualized rate of 3.5% to 4%. So even with the challenges we've seen with supply chains, with the COVID new wave with the Delta variant, but ultimately all of those things really drove yields down in the second quarter, and now we're starting to see that recovery. And don't forget that you're seeing this recovery in the rest of the world as well. You're starting to see the opening through the Eurozone. You're seeing higher vaccination rates within emerging market countries as well. And you're really starting to see economic data improve globally. So yes, there's been some downgrades, but remember, we're coming off of extremely high levels in the second quarter.
So clearly you expect rates to rise on the long end. What percentage chance of significant movement on the short end of Fed rate hikes early next year?
Right. Early next year, I think it's close to nil, Wilfred. I do think it's a very low probability because the chairman himself said that they need to get through the tapering of the bond purchases before they consider raising rates. And so if you listen to the chairman, he said that they want to be wrapped up with their bond buying by sometime middle 2022. So that sets the stage for something after that. So at earliest, if you take the chairman at his words and you just say mid-2022 is June, that says that rate hikes can be in play in the second half of the year. Now, if you look at the 2-year and you take the implied rate from the 2-year, what that means about rate hikes, that kind of puts you at a December rate hike is what the bond market's pricing. And the 2-year is actually at the highest level today that it's been really since the pandemic started, right? Since we really normalized on the front end back in like late March, early April of last year. So in general, the bond market's starting to say, okay, perhaps this transitory isn't relevant anymore, this transitory inflation. Yeah. And listen to the Fed. They're not even talking about transitory anymore. They said they've achieved their inflation goal. They're focused on the labor market, sure, and they really want to start tapering. So I think every signal when you see across the bond market, it's just not long rates. It's not the 10-year and the 30, but it's the 2-year, it's the 5-year, which is thinking about the inflation component. And you're seeing both of those start to move as well. So right now, the entire yield curve is moving, although it is moving a bit more on the back end right now.
So really quickly, Jeff, where does the 10-year end the year?
Well, I think we're going to retest the 175 level that we saw in March. I think everything's set up there, and that's going to be a very critical moment, Sarah, because that's just been the high of the year. So we got to break through there. But as I've been telling you guys for the last few weeks, we see fair value, by all the models that we run that they're old school. They don't take into account all these stimulus. They say the 10-year should be in the high 2s, if not low 3s. So it's going to take time to get there. But I actually wouldn't be surprised if we got close to that 2% 10-year by year end.
There you go. We'll hold you to the prediction. Jeff Sherman, thank you.